Your savings are losing 5% a year without you even noticing. In 2022, US date savers lost $1.2 trillion in purchasing power due to inflation outpacing savings rates. While banks profit from the gap, ordinary people watch their life savings shrink silently. This isn't a new problem. Central banks have been fighting inflation with tools that hurt savers for decades. The invisible tax on your savings isn't a secret. It's a system designed to let money lose value over time. Let's break it down. Between 2020 and 2023, the US faced an average inflation rate of 5.1%, according to the Bureau of Labor Statistics. Meanwhile, savings accounts earned just 0.06% annually per the FDIC. That's a negative real interest rate of -4.94%, meaning your money effectively lost nearly 5% of its value each year. Imagine depositing $100,000 in 2020. It would shrink to about $75,000 in 2040, assuming 3% inflation and 0.06% interest per the US Treasury's inflation calculator. But this isn't just a US problem. In the Eurozone, savers faced even worse odds, 0.25% interest rates in 2023, while inflation hit 9.2% in 2022, per the European Central Bank. The gap between what savers earn and what prices rise is widening globally. Central banks, from the Federal Reserve to the ECB, have long used low or negative rates to stimulate borrowing, but the cost falls squarely on ordinary people. How did we get here? The answer lies in a decades-long battle between inflation and savings returns, one that's quietly destroying wealth. But how did this happen? Between 2020 and 2023, the US faced an average inflation rate of 5.1%, according to the Bureau of Labor Statistics, while savings accounts earned just 0.06% annually, per the FDIC. That's a negative real interest rate of -4.94%, meaning your money effectively lost nearly 5% of its value each year. Imagine depositing $100,000 in 2020. It would shrink to about $75,000 in 2040, assuming 3% inflation and 0.06% interest, per the US Treasury's inflation calculator. This erosion isn't theoretical. It's a silent tax on your savings, compounded every year. The problem isn't confined to the US. In the Eurozone, savers faced even worse odds, 25% interest rates in 2023, while inflation hit 9.2% in 2022, per the European Central Bank. That gap between what savers earn and what prices rise is widening globally. Central banks, from the Federal Reserve to the ECB, have long used low or negative rates to stimulate borrowing, but the cost falls squarely on ordinary people. The roots of this crisis stretch back to 2008. After the global financial crisis, central banks implemented zero-interest rate policies to revive economies. The IMF's 2020 report highlighted how these policies kept savings rates near zero for over a decade, accelerating wealth erosion for savers. Jerome Powell, chair of the Federal Reserve since 2018, has defended low rates as necessary for economic recovery. But the math remains brutal. For every dollar saved, inflation steals nearly 5 cents annually. This isn't just about numbers, it's about power. When central banks set rates, they decide who profits and who loses. Savers, especially low-income households, are the silent losers. Meanwhile, banks and borrowers reap the benefits of artificially low rates. The system is rigged, but the rules are written in plain sight. The question is, will you keep saving in a game where the odds are stacked against you? The 1970s were a battleground between savers and inflation. From 1979 to 1981, US inflation surged to 13.5% annually, the highest since the 1920s. Yet, savings accounts offered a lifeline. Average interest rates hit 11.5%, temporarily shielding savers from erosion. This brief reprieve was a product of the Federal Reserve's aggressive rate hikes under Paul Volcker, who later called the period a necessary sacrifice to curb inflation. But this balance was fragile. By 1982, rates fell to 6%, and inflation dropped to 3.8%, leaving savers with a new problem: stagnant returns in a low-inflation era. The 2008 financial crisis marked a turning point. In response to the collapse, central banks globally adopted zero-interest rate policies, keeping savings rates near zero for over a decade. The U.S. Federal Reserve, led by Ben Bernanke until 2014, justified this as a tool to stimulate borrowing and spending. But the cost was clear. Savers earned nothing while inflation crept upward. By 2012, the Fed's quantitative easing program injected $4 trillion into the economy, yet savings accounts still yielded less than 1%. Jerome Powell, who later became Fed chair in 2018, defended these policies as necessary. But the math was brutal. For every dollar saved, inflation stole 5 cents annually. The 2020-2023 post-pandemic surge tested the system again. As inflation spiked to 9.1% in 2022, savings accounts remained stuck at 0.06%, creating a minus 6.5% real return. The Federal Reserve raised rates to 5.25 to 5.50% by 2023, but banks passed only a fraction of that to savers. Meanwhile, in Europe, Mario Draghi's European Central Bank imposed negative interest rates on banks in 2014, indirectly slashing savings yields. By 2023, Eurozone savers faced 9.25% rates, while inflation hit 9.2% in 2022, a gap that left households with no buffer against rising prices. These policies, once hailed as economic lifelines, now read like a silent tax on ordinary people's savings. The erosion of savings isn't just a quiet loss, it's a chain reaction that reshapes economies and lives. Low-income households, who rely heavily on savings accounts, bore the brunt of the 2022 inflation surge. A Brookings Institution study found they lost 30% more purchasing power than high-net-worth individuals who diversified into stocks, real estate, or private equity. This gap isn't accidental, it's structural. When interest rates hover near zero, the poor, already holding a smaller share of wealth, see their savings shrink, while the wealthy grow theirs through investments that outpace inflation. Meanwhile, banks turned the crisis into a windfall. In 2022, U.S. banks earned $11.5 billion from the interest rate spread between what they paid depositors and what they charged borrowers. This profit margin, amplified by the Fed's rate hikes, became a lifeline for financial institutions. Yet for everyday savers, the math was brutal. Every dollar in a savings account lost 5.4 cents inflation in 2022 alone. Faced with this reality, 12% of U.S. savers, over 15 million people, shifted funds to cryptocurrencies in 2022, according to Pew Research. Bitcoin and Ethereum, despite their volatility, offered a hedge against dollar depreciation. But this wasn't the only response. In Japan, the Ministry of Finance introduced a negative interest rate compensation program in 2021, giving retirees a 0.1% annual bonus on savings to offset erosion. It was a small fix for a systemic problem. When central banks prioritize economic growth over saver protection, the cost is borne by ordinary people. The dominoes keep falling. As savers flee traditional accounts, banks face a liquidity crisis. The FDIC reported a 15% drop in savings account balances in 2023, forcing institutions to offer higher rates to retain deposits. But with inflation still above 3% in the US, the gap remains. This isn't just about money, it's about power. Who controls the rules of the game? Who profits when the system tilts? The answer is written in the numbers, and it's not in your favor. The future of wealth inequality hinges on how individuals and institutions respond to this crisis. By 2030, the IMF projects that persistent low savings yields could widen the wealth gap by *15%, with low-income households falling further behind. Consider this: a $100,000 savings account in 2023 earning 0.06% interest would be worth $73,000 in 2040 at 3% inflation. For a middle-class family relying on this savings, it's not just a number, it's a future eroded by policies designed to benefit borrowers and investors. Meanwhile, high-net-worth individuals who allocate 70% of their assets to stocks, real estate, and private equity see their wealth grow at 7 to 10% annually, outpacing inflation by a wide margin. This divergence isn't accidental, it's systemic. Financial literacy programs are now a lifeline. The OECD's 2023 report highlighted that *60% of Americans still confuse nominal interest rates with real returns, a gap that leaves them vulnerable. Yet, initiatives like the U.S. Treasury's inflation calculator, which shows how $100 in 1970 buys only $17 today, are slowly closing this gap. Still, the challenge remains. How do you teach a generation that grew up in a low-inflation era to navigate one where returns are negative? The shift in investment behavior is undeniable. Robo-advisors like Betterment and Wealthfront now manage $300 billion in assets, a 200% increase since 2020. These platforms democratize access to diversified portfolios, but they also signal a broader cultural shift. Younger investors who grew up during the 2008 crisis and the 2020 pandemic are less trusting of banks and more willing to take calculated risks. Joseph Stiglitz, in his 2022 book, People, Power, Change, warned that this distrust could fracture the traditional banking model. Money talks, but only if you understand the language. Subscribe for more stories behind the economy. Tell us in the comments, did you see this coming? Shamnain.